Hello everyone and welcome to the webinar Sustainability Intelligence, a crucial corporate capability that can be supported by our market and competitive intelligence solutions, Intelligence Today. The webinar is being hosted by Quantitative that provides competitive and market intelligence solutions to the customers worldwide to help them turn data into insights so they can make better business decisions. The presenters today are Gabriel Anderbjörk, who is an entrepreneur, consultant, and CEO of Inzyon. We also have Thomas Wulf, who is the Secretary-General of the European Structured Investment Products Associations since 2012.
Thank you very much, Malika. I need to share my screen. I'm going to do that here.
Yeah.
There we go. So are we all up with the screen?
Perfect.
Super, super. Well, thank you very much, everyone, for attending this webinar. It will be an exceptional discussion, I hope, with the theme of sustainability and ESG. And I also want to say very many thanks to Thomas Wulf, who accepted to participate as co-host of this. Very welcome, Thomas.
Thank you for the invitation, Gabriel.
The plan for this webinar is that we will start with two sort of sections of some introductory slides. I will have a few slides in the beginning, and following that, Thomas will run through a few slides, and then we'll end up in a slide with a number of discussion points. And we very much hope that those of you who are attending, that you are actively contributing with questions, and you're also welcome to contribute with comments if you like. And Malika is going to help us to make sure that we get all that into the discussion. But let's start with those first introductory slides. The first question, obviously, is, why are we talking about sustainability intelligence? But essentially, there are two key factors that we need to take into account here. And one is that we are looking to a demand from both market and regulators when it comes to sustainability. And very often when we hear about sustainability these days, we hear about it from a perspective of climate change. But keep in mind, we have all the 17 sustainable development goals to adhere to. And I mean, if you like to condense what all these different goals are there for, it's really to start to alter our behavior when it comes to global consumption. And typically consumption is something that happens when I, as an individual, procure something. It could be a service, it could be goods or whatever, but that is from a company. So at the core of all this sustainability efforts that we are now seeing taking place will be companies. Companies or businesses, large corporates, small locals, etc. And what we're going to look into at this webinar is really what is happening in that sort of interface between companies, regulators, and markets, and how is this going to evolve, and how can we help in that intelligence aspect of making those companies comply. Just as a brief introduction to the world of sustainability classification, what you see on the screen is a selection of different frameworks that companies and organizations are working with when it comes to adhering to sustainability. The one that most people probably know about is the Sustainable Development Goals that I'm pointing at here. But you also have the International Labour Organizations, you have the UN Global Compact, you have the EU taxonomy that we're going to talk more about. There are also different reporting standards such as GRI, SASB, the PRI, are putting very sort of specific requirements of various kinds of organizations. And all these are, the environment and the universe that sustainability companies need to adhere to. And by the way, Thomas, anytime you want to jump in, please do so in those slides as well. Very few words just about intelligence operations in general. The two bullets on the left-hand side here is just me summarizing, what an organization needs to think about when it comes to building an intelligence capability. And it's really making sure you have a corporate capability of being the #1 provider of choice on the market that you're addressing. And the way of doing that is, of course, making sure that the gap between whatever strategy you're deploying as an industry company is as small as possible towards what your market is looking for. So the entire intelligence apparatus of an organization really focuses on making sure that you do the right thing for the market you're addressing. And there's nothing different from building, for instance, a market competitive intelligence or a technology intelligence operation, and those of sustainability. Sustainability development or sustainable development is here to stay. I mean, there's nothing that will make this blow over if anyone thought that. On the contrary, it's getting more and more sort of intense, as we will hear in a few minutes from now. And as I say here, at a pace that few seem to have yet embraced. When we talk to people in industry, the awareness is definitely there. But when we start looking at the pace of when regulations will actually hit, what the market trends are in terms of how consumers are actually placing requirements on their providers, younger people walking in through the door in a garment shop, they're aware now. They look at those things, so they keep track of which companies actually do what they tell the market that they're doing. So this is something that is extremely central to a lot of people out there right now. Getting a little bit into the challenge. Some of you might have heard about the different scoring systems, and this is just an example of what we're up against when it comes to measuring this whole thing about sustainability. This is taken from a conference that I attended some months ago, as you see, I think it was in September, Foresight and Sustainability Summit. And what this graph at the lower end, right hand, says here is, these are two of the major sort of ratings organizations that have been rating exactly the same type of parameters. And had it be that their way of measuring would have been similar, all these scattered points would have been a straight line from top left to bottom right. What this tells us is that even if we're just comparing two different companies measuring, it's completed scattered as a shotgun. And these are just two. And there are a number of different companies doing the same type of measuring and ratings. And the problem is that if we're getting this sort of scattered pictures, what to trust? How can I, as an industry company, how can I, as someone who's operating on the market, do something so I am, at least from my perspective, sure that I can stand up for what I'm saying? I'm doing this, which is sustainable. Well, in which way? Well, I need to prove that. And that is where we come in with the sort of the internal works of the intelligence operations in this as well. But this is just an example of a challenge we're up against. What we're also seeing is that we have a sort of, how can I say, not a contradictory situation, but between quantitative and qualitative data. It's very traditional, particularly in the financial industry, to be looking for quantitative data. We need measure points. We need exact figures. And the problem is that current compliance measures are not fully quantifiable, making the qualitative assessment a definite necessity. And the compliance measures are currently developing very, very rapidly. And when you have in an early stage of a compliance sort of requirement, it will take some time before you get the figures in place. So if someone comes to me as an industry company and say, are you complying with this and that regulation? Some will definitely have quantitative possibilities, some will not. And there are also some other aspects that I'll come back to in the next slide when it comes to this thing about quantification. But I think, Thomas, you have some thoughts here as well, right?
Right. I think, thank you. And just a quick comment from my side. My name is Thomas Wulf. I'm heading the European Structural Investment Products Association, EUSIPA, as the Secretary-General, and looking at this discussion here, of course, with a great interest, especially from the end of the financial services and financial product providers, manufacturers, if you like. As you just said, Gabriel, we are noting a trend that is something irreversible, which is indeed that we are moving from providing or documenting the ESG quality of services of corporates in the end, corporate business lines, no longer only by a range of qualitative measurements, as has traditionally been the case. So the question of whether you are part of a specific, have subscribed to a specific global agreement, set of principles in your sector, but that we actually see that more and more, and this is driven through the financial sector, which we are going to come back to in the next slides, that you are required as a corporate to put a number to this specific criterion. So to say, as Gabriel just indicated before, how far does this go? How green is this? How sustainable is this? How far have you achieved the specific target, or at what level are you currently when it comes to this, and this of the zillion aspects of sustainability that we group as ESG. And that is a major evolution. This is a game changer in the whole picture. And indeed, we could come back to that on the next slides. But Gabriel, that was just a quick comment to reconfirm.
Sure,
what you said is something driven through the financial sector, so infiltrating the corporate reporting landscape through the relationship to financial service providers. You all are going to face this in the relationships that you have with your banking, your financial environment, your financial service provider environment, that you're being required to do this for the sake of fulfilling the legal requirements of these financial institutions, not only because it's requested by law of you as a corporate entity. So that is, I think, something really important to bear in mind.
We'll come back to that in a few slides, trust us. I mean, it's all a question of that every single company that needs access to some sort of capital market will need to adhere to various kinds of regulations here, but we'll come back to that. Now, what we're saying here is also when it comes to those quantitative scorings, usually what we see today is that you will get those scores in quarterly reports or even just annual reports right now from corporates, for the simple reason that sourcing the actual data is quite tricky. Whereas what you need to build up is really a more or less real-time or continuous capability in your organizations to keep track of, one, what is going on the market, and two, what are we doing in this market? You can't just wait and see what happens when you do your next quarterly report. That means that what you need is really getting some sort of operation in place that in between the quarters also monitors what you're doing and what the market is doing. And what that would lead to, sorry, that was wrong direction, apologies, there you go. What this will lead to is that you eventually build up a capability for more or less real-time analysis that predicts what to come. And if you're in the financial services side here, this will actually help you predict what will happen in your portfolio. And if you're on the industry side, it will help you predict what you need to take in terms of measures to adhere to whatever the requirements are. So this is something that goes for both sides of the equation, you know, both the financiers and the industry companies. And we think this is core to what is going to happen over the years to come right now. So how to do this now? This is my last slide before I leave over to a few slides for Thomas. It's very much, you know, as an industry company, you need to provide support to and have an impact on the decision makings of all kind in your company. And as I said before, developing a sustainability intelligence capabilities doesn't differ at all from a market or any other type of intelligence operations. There is a set of components that you need to address in order to make this. You need to have a good and professional source mix, and this could be your Sustainalytics, your Bloomberg, whatever. I mean, those that will help you with actual numerics. There will be news providers, such as Factiva is a good one. You know, you bring in all these kinds of different unstructured data. You work with them, but of course also every internal information you can get hold of. That's your differentiator. That's how you can build up a capability to make sure you can tell the market what you're doing more or less on a real-time basis. You need an information model with capable algorithms and everything. I mean, the amount of information in this field is absolutely astonishing. There's no way that this could be done entirely manual. You need some sort of IT tools, and we're here with Intelligence2day, of course, as an example of that, in order to manage this. You need a subject matter expert team within your organization. And this is something that we'll come back to this, you know, what industry companies need to think about. But at least from our perspective so far, those of you who have expanded this, don't mistake us for not being, you know, haven't seen that as well. But there is a situation where many companies still have this very much at the center. But what needs to happen is really that you have to involve your entire organization. You have to have your sensors very close to the market. And I mean, we will come back to this again, but I mean, think about just the supply chain problem in many of those organizations that spread out to areas of the world where it might not be that easy to keep track of what the working conditions are for some people, where things can get really nasty if you are not picking up on issues in that value chain or supply chain.
So what we are seeing, Gabriel, if I can just slot in a quick comment, what we are seeing is that more and more, and we're coming to the correlation of these two areas on the next slides, but that the ESG management, if you like, is somewhat seen and can be seen as being of a similar significance and relevance as the operational risk management of a company. So you would not want to assess the operational risk, to which the supply chain management belongs, just once a year and then tick the box and just wait a year and then look at it again. But actually you would constantly monitor the supply chain operational risk of functioning, of timeliness, punctuality, and costliness. And you can actually use the same idea, and this is something what we see evolving across all sectors, including but not limited to the financial sector. You can use the same idea to the ESG aspect of things. It's not something that you just will look at only once in a year's time, but you will have to constantly monitor it. You will see incidents, you will have to handle incidents, you have to report on incidents, you probably have to document what you do in dealing with these incidents, or a simple downgrade or a change of ESG relevant benchmarks that you try to adhere to. So when you're underperforming, it's immediately something you need to explain and you need to do something against. And this is again a game changer to what we've seen a few years ago, where it was more a static exercise. It becomes a dynamic exercise. It's an area where we, similar to the operational risk management, will have a constant need, or a need for constant monitoring. Sorry, Gabriel, that was just...
Yeah, no, that's perfect. Actually, you're very much along the line that I often take the quality processes in a company as a comparison. That if you go back like 20, 30 years, what you just said about, the ones of every time, that was exactly what happened. I remember myself at that time when we had quality audits, that was once a year. Someone came up, checked a couple of boxes, and then they went back again. And I mean, now, if there's not a quality sort of inherent quality monitoring every single aspect of a company with all the ISO standards and everything, I mean, you're really having a problem. And I think this is exactly what you're referring to, Thomas, that we need to get that kind of thinking into the sustainability management as well. It needs to be absolutely continuous, and the incident reporting must be more or less immediate if something happens. Because, if you do something on a market and a mistake, and you don't react on it immediately, the market and the media will be there before you, and you don't want that.
Exactly.
You don't want that. Yeah. So that was my introductory slides, and I'm going to leave a few more slides to Thomas.
Yes, thank you.
Tell me where you want me to click on the next.
No, thank you again for the invitation. Great to having you here, to having the audience here. I mean, in terms of listening to this, we think, Gabriel and I, this is a really an area where we have to early prepare, because if you just jump to the next slide, Gabriel, what we're seeing actually in the European Union is that Europe is leading for once the pack. Not surprisingly, you may say, because it's about regulation. Indeed, it is, but nonetheless, it is something where Europe has had the ambition to lead the pack, and they have actually managed to do so quite successfully. While of course you can discuss, and we'll do this later on, to what extent this is creating also a problem and a risk of its own. But as things stand for now, and you may have a look at this graph that quite illustratively, I think, sets out the current trends. I think you have Europe setting the benchmark, and we're seeing actually, I just was on a call with American colleagues earlier this morning on principal adverse impact indicators, which is a specific subset of sustainability related aspects for corporates and banks, where they're actually looking at what Europe is doing in terms of defining them in more detail. So the US, for once, was an authority actually calling, looking at what Europe is doing, and you see it also being pushed by Asia as well. It is something which is not going away. which in a typically European way, in a legalistic way, is put out in a number of frameworks and rules that are often not very well concerted amongst each other. So this is creating the issue. But it is something that sets a clear benchmark that we think the industry is going to follow, having to follow, and it's probably also, that is another promising trend, probably building into a unique selling proposition from a European end. For that to happen, you need to sort of make sure you understand exactly what you have to do, and that is something we want to comment on briefly on the next slide. If you set that up. Exactly. So what we're seeing is actually, if you look at it from top to down, is actually an evolution that started here at the regulatory end with the taxonomy. So you have rules that define what corporate business behavior is seen as sustainable, and reversely carrying the message which behavior is not seen as sustainable. Now the next level of that is the disclosure rules. So you have to report, you have to be transparent, you have to just bring clarity to what you do, how you do it, and what the problems are. And that was done in the first step. We had it before in a qualitative way, but now increasingly is done in a quantitative way, that you have to specify how sustainable are you. Now, that being done, it's not the end of it. You will see the third step, which are naming rules and restrictions in terms of what you as a producer of goods, as a provider of services, be it in the corporate life, be it in the financial service life, can call as sustainable. And that is something where we have the greenwashing question, of course, in there. But this is the first level of restriction. So the first was just disclosure. So you have to be open. You have to say what you're doing and to what extent you comply with the taxonomy. But now actually you are restricted at this first level in terms of what is it that you can call sustainable. And at the last level is, of course, when specific rules are coming into force, which force you to do something that is considered sustainable on the price of not doing something else. And that is, of course, in a free market economy, something very rigorous, something rather rare as well. But given the importance of the topic that we are discussing here, I mean, ESG is about, in the end, saving the planet. So it is something that policymakers simply consider as acceptable. So it's going to come. And in the financial sector, this is the example that you see on the slide. We are thinking that at one point, not in the too far future, we are going to see the equity capital ratio of banks being linked, and insurance companies being linked to the greenness, to the sustainability quality of their balance sheet. So in other words, you have to hold less equity capital as a reserve for a green exposure, while you have to hold more. You're punished probably when you hold non-green or brown exposure, as it's called. Details of that are not yet there. It's not an existing rule, but we are waiting for a report on that by the banking authority, a European banking authority, to come by 2025. But there's a clear intention to move into that area. So this is all giving you the picture or the trend as the screws get tightened, and we have to live with it. We have to adapt, and we have to have a smart way of dealing with it. If you go to the next slide, Gabriel. So what was mentioned already? Is the quantification of things. So I've briefly sketched it out. It's essentially coming something that is not to replace the qualitative assessment which is there. So whether you subscribe to specific UN principles of this and that in this and the sector, but which actually on top requires you to specify how sustainable is a specific subsidiary, is a specific business line, is a specific activity, is a specific part of the supply chain, is a specific product that you offer. And of course, the driver for that is that the institutions, the public, the political side would wish to track how much progress do we make in transforming the economy. And for that, you have to measure things at one point. And of course, a quantification is a fantastic tool to combat greenwashing, because you have to put clear number to a claim, and the number can be more easily verified than a yes or no answer. So this is something which we see as a trend throughout the corporate and financial services world. Just to illustrate what we mean by that and where quantification gets particularly relevant, in the corporate life as of 2023, you have to disclose not just the statement that you have to disclose under NFDR right now, but you actually have to disclose a taxonomy ratio for the corporate balance sheet. That means you have to evaluate the assets you hold on balance for the taxonomy eligibility. And as of 2024, banks are going to have to do the same thing, because they will look at the corporate reporting of 2023, and that's the sequencing makes much sense, of course, to check against the corporate reporting, first and foremost, their loan book, and to see how green is their balance sheet. And it will never be 100%, as you can take from the approach already. So, but we will be, as of 2024, very clear on where we stand in the transformation of the business world towards a more sustainable dimension. So this leads to a very drastic consequence, medium term, short term probably even, medium term at least, that everything you do in your interaction, not only with the customer who will demand this as well, but with the financial institutions that you as a corporate deal with, you will face an increasing pressure to simply be very specific, be very comprehensive in your reporting on the taxonomy relevant aspects of your business in all senses. And there may be a consequence for that if you're not. So this is simply something which is inevitable, I think.
And Thomas, as we discussed before, the consequences, I mean, in the absolute worst case, a corporation could end up without access to the financial markets if they don't comply at all. Is that correct?
That is correct. Absolutely. It is something that is already sort of as a trend, discernible, if you like, in the markets, as the checks are already put in place in terms of how taxonomy aligned are my business partners, are my customers, both retail and commercial wise. I think on the retail side, you look at the products. At the institutional side, you also look at the counterparty. So this is, I think, absolutely fair, and this will increase. And if at one point you're going to have an equity capital related regulation that links the capital ratio to ESG risk, this is going to have a huge impact on the market, obviously. And I'm not saying this is something which has to be welcomed with open arms at all aspects. There are lots of things you need to be thoroughly thought through, but the trend is clearly going into this direction. So yeah, I mean, this is something that we just wanted to flag with you, which is why it deserves an own slide. Looking at the state of play of the different regulations, frameworks, directives, we've mapped out, just also for more detailed reading, if you're interested here, what we're seeing across the years and what's going to come, and the main points I've mentioned already. You have with the marked with the green field, you have the various dimensions. So the product disclosure rules, the corporate disclosure in 2023, and the integration of sustainability preferences at the customer end. This is a bit tweaked to financial institutions, but it has direct repercussions on corporates, because financial institutions sell products based on indices, based on loan exposure, or any other exposure to the corporate world, to institutional retail investors. And to sell them as a sustainable product, they need to have the relevant data from the corporate world to underpin this claim. And the conditions for communicating these sustainability related aspects are getting more and more rigorous, which is why this is something which we have to keep an eye on, and which you will see, or maybe are very familiar with already. You also see it at the second slide on this topic, which is
Thomas, before we move to that second slide, I just
Yeah.
realized that we're talking about something that we might want to clarify for some of the listeners. And that's when you talk about products, it might not be mobile phones or
Oh, sorry. Yes, indeed.
yeah,
I mean,
what do we mean by products in this particular slide?
right, right. By products here, we mean financial products. So products which what I mentioned before. So maybe any sort of investment product, structured products, insurance solutions, the debt securities with certain features that are sold as an investment product, as an investment solution to an institutional or to a retail investor, and all of which are linked to a specific corporate risk. So a bank will want to know for selling this product to what extent the corporate risk that this product is related to has an ESG aspect or not, and will communicate on this, because we have high and increasing demand by institutional investors and retail investors for such sustainable product or products with a financial products with a sustainability aspect. As I said, the reporting is getting increasingly rigorous, that banks have to undertake to sell such financial solutions. That means, reversely, that corporates are being asked to an increasing level to report properly and constantly on the ESG aspects of the taxonomy aspects of their business. That is the what we are going to see more and more over the coming months, when all these regulations, directives come into force, as you see here on this slide. Mm-hmm. Again, this is the focus on the taxonomy aspect, so not on the corporate reporting. Just if you remember the slide we had before, just the first aspect, the taxonomy, which is rolled out and which is not static neither. It's very important to understand that the taxonomy as it stands now is rolled out. So the taxonomy, again, is a clear legislative definition of what business behavior is seen as sustainable or not. And it is, as it is rolled out right now, based on a legal act, but it will be evolved constantly. We're going to see it will be enriched in the coming months and years by a social component. So for the moment, we're very much focused on the environmental component with a few social aspects. But we have a G as well, which is the governance aspect that will come to it. But it won't be final even then. The taxonomy is clearly, from its setup, a tool to constantly put the barrier even a bit higher. So to ensure that the whole society, in the end, the economy first and foremost, but with the society, is taking things to a different sustainability level. This is the political ambition behind the taxonomy. So the taxonomy is not static neither. And that is a big challenge. And this slide just means to illustrate the steep increase of taxonomy rules that are to be looked at. At the lower right-hand corner, you see taxonomy alignment, which is meant as of 2023, taxonomy alignment reporting for corporates, and then the very right-hand lower corner, the taxonomy alignment for banks, based on the taxonomy alignment reporting of corporates. That is a snapshot. Sorry, yeah, Gabriel?
I would say, if I understand you right, Thomas, one thing that is very clear in this slide is also that the January 1st, 2023 date when corporates eventually are going to start reporting along these lines, which means that essentially we have the remainder of 2022 to prepare for this, to build up the capability of finding all these sort of measure points within your organizations. And, right. And that's a very, very short time to develop that capability unless that has already been started, right?
Yes, indeed, it surely has started in many corporates already. Yeah. But again, the taxonomy won't be over with this thing coming into force. There will be another set of rules expected for 2025 that deals more consistently, in a more detailed manner with the social aspects of it, and then there will be another one on the governance side. So we just have a new dimension here we have to live in and to do business in. It's as huge as that.
Okay, that actually takes us to our last slide in this show, but we might spend some time here. I actually want to ask Malika if there has been any sort of comments or questions that we want to bring in at this point.
Yeah, actually, we do have a couple of questions So the first question is it likely that US and Asia will adopt the EU regulation structure?
I think, Thomas, you're the better one to answer that one.
Yeah, I think it is the ambition, of course, that of the European rulemakers that the US and Asia are going to take on the basic principles of it. I would say, I don't know whether it is likely that they will copy paste it, but they surely take this as a benchmark. So the funny thing is sustainability as a concept, you can apply that also to government institutions and to the functioning of government infrastructure, so of statecraft in the end. So you can make a judgment to what extent US legislation falls behind EU legislation and Asian legislation and country-specific legislation in general. So, and I think neither government, at least the government in the US, would not want to be seen as being totally out of touch, totally out of line with the EU. So I would think that there is a strong driver to sort of catch up at this end. While there's, of course, always, there are always items of political relevance where, take the fracking industry, where they will probably have tough discussion, or they would probably single them out. So I think that is something we should expect. But in general, I think the EU here sets the benchmark, indeed. And in medium term, I would think in many aspects you would want to catch up, at least at the side of OECD countries. So I'm not speaking for the whole of Asia, but OECD countries and the US included. They would want to see themselves catching up to this.
And I think we can pause one of you had some more questions, but just to jump in here with some of those discussions points that we were looking at. If we feel that corporates actually feel well equipped, and if they have the necessary data to report on these matters, and I mean that we discussed this before, Thomas as well, setting this up, and I mean our general thought is that, well, to some extent, but possibly not even close to sufficient. One sort of matter that we believe is a challenge is this thing, as we discussed before, it has to be happening on an ongoing basis, which essentially connects to the next bullet point here. What happens when there are incidents? How do we react on these things? And I don't know, do you have any thoughts, Thomas, on that? How long, for instance, if we start talking about incidents, how long time will the market accept from an incident until we start sort of addressing it? Is that an area that is being discussed at all so far, or where are we on that kind of sort of regulations?
No need. I mean, that's one of the big gray elephants in the room. I mean, if something happens in the corporate life that infringes with the ESG sort of achievements and diminishes them, or is in contradiction to ESG aspirations or achievements, there would need to be a consequence. And the only sort of example I could look at that deals with the problem is the world of ESG labels that have been set up in the absence of more detailed rules. And many of these labels actually foresee an annual review, so that you have to look at it again, and they do not give you the label for a specific institution or product over a longer time span than 1 year. Now, I don't think that that's going to be the example also for what we're going to have in the corporate world. I think, and in the financial markets world going forward, because I mean, we have to see the situation as it presents itself. You're constantly, the financial services world, financial markets, constantly develop products, investment solutions, and they're not just developed in January and then offered to the market, and then that's done, and then you start another cycle in January. No, you're constantly doing this. So if you're looking to include a corporate in the index that you build, or in the portfolio that you build, or in the basket that you put together for a specific investment solution, you need now the status quo of where this corporate is, which is why the financial institutions are going to have a constant monitoring of the ESG landscape. And if there's a major incident, they would rather want to stay out of taking in this corporate at this moment. So irrespective of the regulatory treatment, you have the market treatment of the incident situation. Now, that being said, if the corporate, for example, demonstrates that everything's being done to remedy the shortcoming, to sort of improve, to sort of make sure the incidence is just limited, is being dealt with, is properly handled, this is probably fine. But the pressure comes already from the market, comes here from the financial institution.
Yeah. I think that is also very sort of, telling proof that if you're a corporate and you need to service your sort of investors and loan providers in the banks, you need to be there and essentially find your incidents before the market does. Because if you don't, the likeliness of there being a rather long time span from finding the incident to remedying the incident is pretty long compared to if you have your own monitoring internal system, making sure that you pick up on it immediately when it happens.
Yes, indeed.
Let's say, Malika, you had some more before we jump into some of the others here?
Yeah. We have another one here. How does this differ between industries? Are you more regulated as a pharma company than as a manufacturing company?
Yeah, that's interesting. You might believe that if you're in the pharma industry, you're more regulated than, for instance, in manufacturing, as there are many more regulations, I would say now, going towards the, chemicals and pharma. But when it comes to this area, my shot would be that no, there isn't. They're all up against the same ESG regulations. Wouldn't that be correct, Thomas? I mean, you don't differentiate in that way, or does the market do that?
I think there's a core set of principles you have to look at, especially when it comes to corporate governance. That will be refined still, but of course, when it comes to the environmental aspect, you may have different challenges depending on the industry that you work in, depending on the supply chain that you run. But it's difficult to say pharmaceuticals are more exposed than energy companies or manufacturing companies. I mean, it really depends on the individual setup of your business, to what extent you're exposed to a specific environment, specific ESG risk or specific ESG aspect. So
yeah, and I guess you're sort of, for instance, environmental footprint. The house of the environmental footprint differs, of course, between different industries. But what I would guess is that you're in exactly the same frameworks. And when you talk about, for instance, taxonomy alignment, everything, there's nothing that differs one industry from another. They will all be part of the same timeline. It's just that they're different industry activities that will sort of hit in terms of what they need to report.
Right, absolutely. That's correct. I mean, the reporting disclosure requirements are the same, indeed, and that there's no difference between them. It's just the intensity to what. In terms of your exposure to a specific risk that may be differ. But again, that cannot be generalized in a way that you could say this sector very exposed, this sector less exposed, because it depends ultimately on your supply chain, on your business partners, on the way you do business outside and inside your home market. It cannot be generalized, I think.
No. And I think, as you say, also, I mean, this one of our bullets here, the third one on the left-hand side, fraudulent behavior in your supply chain. It all goes back to, really keeping track of your entire supply chain from the very, very start. So are you mining minerals in areas where it might not be that sort of positive to mine minerals that could, hit back on you? We have a case now in Sweden with one of the big companies here where they chop woods for the farm, for the furniture. That's been discussed. I don't know whether it's been clarified if it sort of was or wasn't erroneous when it comes to sustainability, but it's been discussed at least. And of course, if you're running a big company, it can sometimes be very hard to know exactly what is happening at the end of a tail in terms of sourcing of products and sourcing of services. But that is definitely something that will need to be included in the monitoring.
Absolutely, absolutely. And also the regulation of this monitoring is such, is getting more and more dense. And I've just seen today, we shared it before the call, and maybe you can even, if someone's interested from the audience, share that. I'm working in Brussels, and we have seen a leak today, which is probably deliberate, of documents from the EU Commission, which is the draft regulations, nothing rare. It's circulating at one point without being an official release, but it's just a piece of paper dealing with the corporate sustainability due diligence on principal adverse impact indicators, as the technical title runs. So more in detail, it actually tells you as a corporate how you need to evaluate your supply chain, your business, when it comes to specific PAIs. For example, forced labor is in there, and commodity business, if you're using commodity and especially minerals. So this is something where they put up, not because they'd like to put out regulation for the sake of having regulation, but just because they put out standards that auditors can use to report on these aspects, to make essentially life easier for corporates to have a benchmark in terms of their own reporting and auditing. Reversely, corporates will be measured against these standards by their business partners, which includes the financial industry. So it is a ever denser becoming area of our business life. And it's well integrated and thought through in many aspects. In some aspects, there is some room to improve, but it is something that is there to stay. So this is the important bit.
It is. And we discussed it earlier a bit, but this question we have here: what will the effects be on a company not complying with all these things? And as we discussed, the sort of ultimate consequence will be that you will not be able to raise funds either on the capital market or on the sort of the debt market. But do you know, Thomas, are there any sort of in-betweens, any sort of sanctions that are still sort of bearable, or how will regulators work there? Are we...
Well, at the regulatory end, I mean, you first and foremost at the moment you're at the disclosure end, so you would have to disclose what's wrong, that you can't comply, that you won't comply for whatever reason, maybe a very good reason that you can't comply, because there's an incident in the supply chain that you simply cannot have under control, cannot have foreseen. You've done everything you could, but there is an incident in some part of your supply chain. You detect forced labor, for example. And though you run a complete audit with trusted service providers who run this audit in that country usually. So, but it happened. So it happened. You are transparent about it. But you're non-compliant at the moment. So you have to change it. You have to do something. And I think the pressure comes from your customers, comes, however, also from your investors, and comes from your financial service providers, who again see you as a part of their own risk book, of their portfolio, who will then drill down on you. Interestingly, that is something not to be underestimated. Financial institutions, investors in particular, institutional investors are asked by their own statutes, their own rules, to engage. So they are having their own benchmark in terms of how do they influence corporate behavior through a certain shareholder-based engagement. And that is, of course, a very powerful tool, but it's something, again, which is not up to their discretion, but they, for the sake of themselves being seen as part of the sustainable business landscape, they are asked to engage in the holdings, in the shareholdings that they manage towards the corporates that they are exposed to, and to make these corporates pick up on the incidents, change behavior, reconstruct supply chains. So this is, I think, where the pressure will culminate. It's not necessarily a regulator intervening. You always have that option too, in depending on the sector legislation, of course. But it's the market pressurizing due to sustainability being a goal that you have, not only as a shareholder and as a manager of shareholdings, but also as a business partner. You will be asked questions from your business partners. How do you deal with this? Because they report on you in their own audit on ESG aspects. So this is, I think, the broader picture, and indeed it may lead in an extreme case to a situation that you lose access to a certain level of financial, or a certain price of favorable price of financial services offered to you.
I'm bringing it that price issue. I mean, there's also one thing that I've heard when I discuss with various companies, including banks in this area, that it's been a lot about, you know, the investment side of this. We need this for the taxonomy alignment and everything. But from a corporate perspective, it's important to realize that this is exactly the same sort of requirements, if not already, but will have to be put in place on the credit lines as well. So we all know about this know your customer factor when we get into the bank and we want to discuss with, you know, any sort of banking service. The ESG matters will become an integral part of the KYC. Not that it isn't already. Many work with it, but it seems, at least in the discussions we have, that it will increase significantly over the coming months and years. So essentially, it's not just that we can't, you know, capitalize the company on the financial markets from an equity perspective. It is also on the debt side, and a very concrete consequence of not being adherent to those different factors is that, quite simply, your lending rates will increase. And if you have huge credit lines, I mean, that will be a bottom line effect that you probably would like to avoid, right?
Yeah, indeed. And I mean, it's an amalgam of reputational issues that you need to handle as a financial service provider. You have the pressure of shareholders, and you have, of course, the risk management. And as I said before, I mean, we're expecting at the end of the risk management to see even legal provisions that incentivize you to increase the ESG quota by tapping into equity capital rules. That's not yet the case, but we await that, and to which level we have to see. That being said, it's not all rosy. It is a very tricky next step to sort of correlate ESG management with the general commercial risk management. But it is increasingly advocated that there's a positive correlation in terms of if you look at ESG compliant behavior, if you try to foster ESG compliant business behavior, that there's a positive impact on the stability of your profits. Now, I haven't seen sufficient academic evidence for that yet, but increasingly the point's being made that there is medium long-term such a correlation, or at least the point's being made that it is something we have to just maintain. So the correlation between ESG and risk management is to be accepted, because in the end, ESG is at least as important as a solid operational risk management. And that is, of course, some ideological arguments behind that. But I mean, I'm personally tempted, if I share this here on the call, I'm personally tempted to rather believe that, because if I look at the landscape of medium-sized, small and medium-sized enterprises in Germany, in Austria, in Northern Italy, in Sweden, I mean, many of these companies actually have, throughout centuries sometimes, kept up their business. And that is the most impressive, sustainable behavior. Because these companies are entrenched in a local environment often, or traditionally, they have managed that. They have managed to keep it throughout the centuries. Maybe during wars, they kept their business alive, and they kept it profitable, and they kept it up in a way that shareholders still trust them, and customers still trust them and buy from them. So sustainability as such is nothing new. Long-term, seen through the right lens, I think it indeed fosters the existence and the dominance, market dominance of a company if the business idea is a good one. So
absolutely. And yeah. Malika, any more questions before we start wrapping up?
Yeah, just last one. How can Intelligence2day be used to support this field of work?
Good question.
That's for you, Gabriel.
Thank you. We love to answer that question. Well, I mean, we've been talking about, for instance, this thing about monitoring on a continuous basis. Those of you who are familiar with the platform, if you're customers to Commentelli already, for instance, you know about the monitoring functions where you can sort of look into the market and you can auto-categorize all this. From the Inzyon's perspective, we've added all the ESG perspectives, this SDG perspectives, reporting frameworks, etc., that will automate your sort of the monitoring of what's going on the market when it comes to regulations and actual happenings. But also, as we said, we brought up this thing about the activities and being engaged, working with the financial provider side. You can have engagement logs, you can have incident logs, you can have tools in Intelligence2day that will help you keep track of all these things that eventually will bring up your or bring forward your reporting data. One company we worked with used it for bringing all these different engagement sort of types into graphics, and we've actually seen that in their annual reports on how do we engage with our sort of portfolio companies. So there's a number of different aspects of Intelligence2day that can readily be implemented to support the requirements or support companies and industry companies to adhere to these regulations, and that will of course gradually be developed along the line with the new requirements as well. So, but that just, Malika, if you get any questions on that after this webinar, just let us know. And as we discussed also, Thomas, when it comes to automation, I mean, this whole thing about cutting through the buzzwords, something that we see already, if I understand you right, that there's a number of, like we said, ESG trolling, companies out there just inventing new buzzwords to make things look great. It's within the sort of the greenwashing area, but I mean that again, the amounts of information around these sustainability issues is just not doable to deal with on a manual basis, on an individual basis. So, and that's a perfect, obviously, application of Intelligence2day to make sure that you can pick up on all these and filter out things that are not relevant. So if you like ESG fake news, to make sure that's gone.
Yeah, I can only confirm that from the financial service perspective. That is a strong need. Yeah, I mean, artificial intelligence seems to be a very good tool in helping to achieve that, both to evaluate the own corporate reporting, but also to indeed see how the outside sees the corporate, what the corporate picture in the market, does it really depict the ESG achievements? And that is, I think, a highly valuable tool.
As we discussed, there's one thing what the company says, and another is what the market says about the company. And one thing that you can work with in this environment is to make sure that you identify any gaps. So if company X has this communication, the market start writing something that is completely different or sort of deviates significantly, you could pick up on that one and thereby maybe find sort of indicators on incidents that are about to unearth. And that could be very healthy for the company itself, because obviously, I mean, if you're in a corporation, you communicate what you believe is the truth, and picking up on what is happening on the market that you might not be aware of could be a very, very quick indicator on that something needs to be done.
Yep.
So, yeah.
Okay.
Malika, we're on the hour in 2 minutes. Are there any further questions that you got?
No, that was all the questions we had. I would like to thank you, Thomas and Gabriel, for this insightful presentation. Thanks to all our audience for participating. If you have any further questions, please don't hesitate to reach out to us. You can see the contact details on your screen.
Thank you, Thomas, for joining in. It's been a pleasure discussing it. Yep.
Thank
you, Malika, for hosting.
Thanks for the attention.